So you see those massive billion-dollar headlines, right? A company just posted record profits. But is that the real story? Today, we're going to put on our detective hats. We're going to look past the big, flashy numbers and find the hidden clues in financial reports, the clues that tell you what's actually going on with a company's health. All right, let's dive in. Right, so that's the big question, isn't it? When you see a company boasting about billions in profit, is that really the whole picture? Or is it just the tip of the iceberg? We are about to find out that the most important information, the juiciest clues, they're often hiding right there in plain sight. They're just waiting for someone like you, a sharp-eyed investigator, to uncover them. In this explainer, we're basically building your financial detective kit. I'm going to show you exactly how to look past those flashy headlines and really dig into what's driving a company's performance. Let's get to it. Okay, so here's the best way to think about it. You know the big financial statements, right? The income statement, the balance sheet. Think of those as the cover of a book. They look nice, they give you the title, maybe a cool picture. But the real story, with all the plot twists and the juicy details, that's all hidden in the supplementary sections, the fine print. We're talking about the financial notes, the management's own discussion, and yeah, the auditor's report. And I'm not kidding when I say there can be a lot of fine print. I mean, just take Volkswagen's 2023 financial report. Get this. It had over 160 pages of just the notes. Not the whole report, just the notes. That's a novel in itself. And trust me, that's where the good stuff is buried. All right, let's grab our magnifying glass and look at clue number 1, decoding the financial notes. Now, I know what you're thinking. The notes. Isn't that just a bunch of boring legal jargon? No way. Think of it as the instruction manual, or maybe even the recipe book. It tells you exactly how the company prepared its numbers. So here's the deal. The official rulebooks for accounting, things like IFRS and US GAAP, they actually give companies a surprising amount of wiggle room. It's not as black and white as you might think. Companies get to make choices about how they account for certain things. And the notes are where they have to come clean and tell you exactly which choices they made. Okay, let's break this down because it's super important. You can think of it in 3 parts. First, you've got policies. That's the what, the big overarching principles they're following. Then you've got methods. That's the how, the specific techniques they use, like whether they use FIFO for their inventory. And finally, you have estimates. These are basically their educated guesses about the future, like how long a new machine is going to last. Each one of these is a clue into how management is thinking. But all this flexibility, it's kind of a double-edged sword, right? On one hand, it lets a company's financials reflect its unique situation. But on the other hand, for someone like you trying to compare 2 companies, it can be a total nightmare. I mean, how are you supposed to do an apples-to-apples comparison if one company is playing by slightly different rules than the other? Let me give you a super simple example. Let's say we have 2 companies, Company A and Company B. They both go out and buy the exact same piece of equipment for the same price. Now, Company A decides to spread the cost of that machine out evenly over 10 years, but Company B decides to take a much bigger expense hit in the first few years. What happens? Well, their reported profits are going to look completely different, especially in those early years, even though their actual business operations are identical. It all comes down to that little choice they made in their accounting. See, if you didn't read the notes, you'd be looking at their profit numbers and thinking one company is way less efficient than the other. You'd be comparing apples to oranges. But a real financial detective, knows to go straight to the notes. You find out what they're doing, you can mentally adjust for those differences, and then you can get a true picture of who's actually performing better. And it's not just about depreciation methods. Oh no. The notes are an absolute goldmine for spotting potential trouble down the road. We're talking about things like ongoing lawsuits, exposure to risky financial instruments, maybe some questionable deals with related companies. The stuff that should make you sit up and pay attention. These are the bright red flags you're looking for. Okay, so we've sifted through the notes. Now it's time for clue number 2, management's side of the story. This comes from a section called the Management's Discussion and Analysis, or just MD&A for short. This is literally where the company's leaders get to sit down and tell you in their own words what they think happened during the year and what they think is coming next. Now, the MD&A is arguably one of the most useful parts of the entire report. It's full of incredible context and insight. But, and you have to remember this, it's typically unaudited. That's a huge deal. It means an independent party hasn't checked it. So while it's valuable, you've got to read it with a healthy dose of skepticism. It's their story, told their way. So what are you actually looking for in here? Well, the official bodies, like the IASB, have laid out a pretty good framework. You want to see management talking about 5 key things: the nature of their business, what are their objectives and strategies, what are the big resources and risks they're dealing with, a breakdown of their results, and, crucially, how they measure their own performance. This is their chance to give you the full narrative. And what's really cool about the MD&A is that it's often forward-looking. This is where you might find out about their plans for big investments, capital expenditures, or maybe some exciting new projects they have in the pipeline. It's kind of like a crystal ball, giving you a glimpse of where the company plans to go. Okay, clue number 3. We've dug through the technical details in the notes, we've heard management's narrative in the MD&A, now it's time to bring it all home with the final piece of the puzzle, the auditor's final verdict. This is the judgment from the independent outside expert. So what is an audit, really? It's important to know it's not a 100% ironclad guarantee that every single number is perfect. The official term is that it provides reasonable assurance. What that means in plain English is that an independent auditor has gone through everything and is confident that the financial statements are free from any material errors, mistakes big enough to change your decision as an investor. It's basically the professional stamp of approval. And what you're hoping to see is an unqualified opinion. This is the best you can get. It's a clean opinion. It's the auditor giving a big thumbs up and saying, yep, everything here is presented fairly and follows the rules. It's a green light. Next up is a qualified opinion. This is basically a yes but. The auditor is saying that for the most part, everything looks good, except for one specific area. Maybe they couldn't get enough evidence for one part of the business, or the company isn't following the rules for one specific thing. For a financial detective, a qualified opinion is like a giant flashing arrow pointing right at a potential problem. Then there's the adverse opinion. Okay, this is bad. This is a massive red flag. This is the auditor basically shouting from the rooftops that the company's financial statements do not follow the rules, they're materially misstated, and they should not be relied upon. If you see this, you run. And last, you might see a disclaimer of opinion. This is a weird one. It means the auditor is essentially shrugging their shoulders and saying, we can't give an opinion. Why? Usually it's because the company didn't give them enough information to do their job properly. And that right there is a huge warning sign. If the auditors can't get the info they need, what is the company trying to hide? So there you have it. That's it. You've just assembled your very own financial detective kit. You now have the 3 essential tools you need to look past the headline numbers and find out what's really going on inside a company. So let's quickly recap what's in your toolkit. Number 1, you're going to check the financial notes. That's where you find out how they got their numbers, their policies, methods, and estimates. Number 2, you read the management's discussion and analysis. That's management's side of the story, but you're going to read it with a critical eye, remembering it's unaudited. And number 3, you find the auditor's opinion. That's the final independent verdict. You combine those 3 clues, and you're going to have the full picture. The bottom line is, you now had the skills to read between the lines. You're not just passively reading a report anymore. You are an investigator. You can see beyond the surface. So the only real question left is, what story are you going to uncover first?